Once in history, a government-driven monetary reform shattered three continents at once, unleashing the longest economic depression the world has ever seen. It wasn't the catastrophe of 1929, it was the panic of 1873, a crisis that tore through Austria, collapsed Germany's financial system, shut down Wall Street, and dragged the world into 20 years of stagnation. And to see why, we have to begin where the shockwave first struck: Vienna. In the early 1870s, Austria-Hungary was transforming faster than at any time in its recent history. Vienna was booming. Investors poured money into new boulevards, apartment blocks, and railway stations. A vast real estate boom took shape, financed almost entirely through bank credit. But beneath the excitement lay a fragile structure. Developers depended on continuous lending to keep construction moving. And before a buyer ever appeared, they needed new financing just to pay the interest on the last loan. And buyers themselves also had to borrow from banks to purchase these properties. A single interruption in credit could freeze the entire system. That interruption came from outside Austria. In 1871, newly unified Germany announced its intention to adopt the gold standard. If Germany moved to gold, it would need to dump silver and purchase gold to rebuild its reserves. In practical terms, that meant a wave of silver hitting the market and a rush for gold, pushing silver down, gold up, and widening the gap between the two. As the date for Germany's reform drew closer, silver prices began to accelerate downward. Seeing this, Austria's depositors rushed to withdraw silver and convert it into something that would hold value: gold or foreign currency. Banks watched their primary reserve, silver, evaporate. To protect what remained, they stopped issuing new loans. And when the banks stopped lending, Vienna's real estate boom simply ran out of oxygen. Developers who had relied on constant refinancing could no longer roll over their debts. Projects halted mid-construction. Properties that had been valued at extravagant prices could no longer find bidders. The financing chain snapped, and once collateral lost value, the whole credit system unraveled with it. On May 9, 1873, panic hit Vienna. The stock exchange crashed, brokers failed, and crowds lined up at bank doors demanding silver. Austria became patient zero. News of Vienna's collapse reached Germany within hours. Berlin had spent 2 years in a speculative fever. New railways, new banks, new factories. And with Germany fresh from victory over France in the 1870-71 war, many believed the new empire was entering a golden age. War indemnities from France had flooded Germany with gold and silver. Credit expanded rapidly, banks multiplied their lending, and investors pushed share prices far beyond real profits. When Austria collapsed, German investors panicked. If Vienna's credit system could evaporate overnight, could Berlin's be any safer? But the deeper pressure came from the gold standard itself. Germany had announced the reform in 1871, but the formal switch to gold approached in 1873. As the implementation date neared, banks examined their reserves and realized a simple truth: they did not have enough gold to support the new system. Banks began recalling loans so they could buy gold on the market. Depositors, watching silver fall in value, withdrew their own savings and converted them into gold or anything that would hold value. Credit contracted sharply, almost at once. Projects that had depended on bank money stalled. Companies that had relied on constant refinancing failed. Investors dumped shares to raise cash, sending prices into freefall. Germany's speculative boom collapsed almost as quickly as Austria's. Not because of foreign invasion or political disaster, but because a new currency regime forced banks to tighten credit at the worst possible moment. In trying to stabilize its monetary future, Germany had unintentionally triggered the collapse of its financial present. Across the Atlantic, the United States had experienced its own wave of speculation. Railroads were the lifeline of the American economy, the backbone of trade, migration, and industrial expansion. But they were also expensive, risky, and impossible to build without constant flows of new credit. European capital, especially from Britain, Germany, and the Netherlands, financed much of America's railway expansion. So when Europe tightened lending after the collapses in Vienna and Berlin, the American credit machine shuddered. Without new financing, major rail companies could no longer pay interest on their debts. Projects stalled, payrolls were missed, suppliers went unpaid. At the center of America's financial structure stood J. Cook and Company, the house that had financed the Union war effort and now underwrote the Northern Pacific Railway. As credit evaporated, the house collapsed. On September 18, 1873, J. Cook and Company suspended payments and entered bankruptcy. The news hit Wall Street like a hammer. The New York Stock Exchange closed for 10 days, the longest shutdown in its history. Banks folded. Railways dismissed thousands of workers. Factories reduced output. A regional crisis had become a global one. Austria was too weak to stabilize anything. Its reserves were nearly gone. Germany was tightening credit to secure its gold standard and could not risk lending abroad. France was still paying war reparations and losing gold to Berlin. The Netherlands saw capital flee instead of return. Britain, the only nation with a strong gold reserve, chose not to intervene, believing the crisis was not its responsibility. And the United States, still without a central bank, had no institution capable of organizing a rescue. With no central authority capable of rescue, every nation turned inward. The crisis intensified and spread outward, creating the first truly global financial downturn. Germany's gold standard reform was rational in theory. A unified empire needed a unified, credible, internationally accepted currency. Gold offered stability, prestige, and international trust. But the timing was catastrophic. Germany implemented the reform too quickly, in only 2 years, and without letting financial markets unwind from the credit boom that the Franco-Prussian indemnity had created. It dumped silver rapidly instead of gradually, driving silver down and gold higher. It did not coordinate with Austria, whose silver-based system was extremely vulnerable. It did not build buffers for its own domestic speculative bubble. And it did not recognize that, after unification, its financial actions shaped the entire region. The gold standard was not the problem. The timing and the speed was. The collapse reshaped every economy it touched, each rebuilding along a different path. Austria's banks failed, its projects collapsed, and it entered a long period of credit starvation. Only after asset prices fell to extreme lows did foreign investors slowly return, allowing the economy to stabilize in the late 1870s. Germany recovered by transforming. The same banks that had funded speculation now poured capital into the Ruhr Valley steel mills, Siemens electrical plants, and BASF's chemical factories. Within a decade, the German Empire emerged not as a speculative market, but as an industrial powerhouse. The United States recovered through reorganization. Railroad bankruptcies allowed the weakest lines to fail and the strongest to be consolidated. Financiers like J.P. Morgan rebuilt the system, imposing order on the chaotic railway network. Lower prices boosted American exports, and manufacturing entered its first major global expansion. The world did not escape the crisis. It rebuilt itself, slowly, unevenly, but decisively. Today, the panic of 1873 has faded into the background of history, but its lesson remained, that a modern financial system does not collapse because someone intends it to, but because choices made in one corner of the world can silently destabilize every other. Thanks for watching. This is the Fiscal Ledger, decoding the systems we still live under. The modern world wasn't born in a moment. It was engineered over centuries by capital, law, and design. From medieval credit to modern markets, Europe and North America wrote the operating code of power, and we're still running on it.